Welcome to this explainer. Let's kick things off with a question I know we've all thought about while waiting in line at the cafe. Who actually decides what your morning coffee costs? Is it the barista, the shop owner, or, is it something a bit more invisible? Every single time you tap your card or hand over some cash, you're participating in a massive, totally interconnected system.
It turns out, if we just peel back the layers of a simple price tag, we uncover the fascinating microeconomic forces of supply, demand, elasticity, and surplus that govern our everyday transactions. These are literally the invisible gears turning behind the scenes of every single market, from your local farmer's market all the way to global commodity exchanges. By the time we're done here, you will absolutely never look at a price tag the exact same way again.
Here's our roadmap for today. We'll cover the forces of the market, finding the equilibrium price, what happens when supply and demand shift, elasticity and the stretch factor, and finally, measuring the market's win. Let's get right into it.
Section 1. The forces of the market, the tug-of-war.
So basically, everything in economics stems from this fundamental tug-of-war. First up, we have the law of demand. And honestly, it's pretty intuitive. As prices rise, customers buy less. If a product just gets way too expensive, consumers are going to either buy less of it or substitute it for something cheaper. Like if a famous musician's concert tickets are priced ridiculously high, fewer fans are going to find it worth the money, right? They'll just stay home or maybe go see a cheaper artist instead. The higher the price, the lower the quantity demanded. Simple as that.
But then, on the other side of the rope, we've got the law of supply, and this operates in the exact opposite direction. As prices rise, companies see a whole lot more profit potential, so they naturally increase the supply of those goods. I mean, think about how the soaring prices of lithium for electric vehicle batteries have driven mining companies to just aggressively explore new sources and expand their production. When prices are high, suppliers are heavily incentivized to produce more.
Moving on to Section 2. Finding the equilibrium price, or when buyers and sellers agree.
Let's see how these two completely competing laws finally find some common ground. This dynamic brilliantly illustrates the core tension in literally any market. On one hand, you've got the consumer, and your primary goal is just to save a buck, right? You want to pay the absolute lowest possible price. But on the other hand, the producer's out there trying to maximize their revenue and their profit margin. If a supplier sets the price way higher than a customer is willing to pay, well, the item just sits there gathering dust on the shelf. But if they set it too low, they sell out immediately, sure, but they leave so much potential profit on the table.
But when the price is just right, we hit what economists call the equilibrium price. This is that perfect, magical sweet spot where the market clears completely. Supply perfectly matches demand. Everyone who genuinely wants to purchase the product at that specific price can do so, and suppliers are left with absolutely no dead stock or excess inventory. It's really just a moment of perfect market harmony.
Which brings us to Section 3, when supply and demand shift, also known as real-world chaos. Because let's be real, the real world is almost never perfectly balanced for very long. So, let's look at what happens when things get a bit chaotic. It is so fascinating how every single complex market fluctuation breaks down into 4 really simple predictive rules. Check this out. If supply goes up or demand goes down, prices fall. Conversely, if supply drops or demand spikes, prices rise. Whenever you see a price change at the grocery store or, the gas pump, it is almost always just one of these 4 rules playing out in real time. To really anchor this concept, let's look at a pretty recent historical example. Remember the early days of the COVID-19 pandemic? There was this massive, sudden demand for hand sanitizer that caused severe shortages and crazy price spikes. That is rule number 4 in action. But then, something absolutely amazing happened. Breweries realized, hey, we can use our alcohol-producing equipment to make hand sanitizer. This totally unexpected shift massively increased the overall supply, which eventually helped bring those wild prices right back down to earth.
All right, Section 4. Elasticity and the stretch factor, measuring consumer loyalty.
Now, we need to figure out exactly how sensitive you and I actually are to these shifting prices. The best way to think about elasticity is like the stretch factor of a market. If a product has high demand elasticity, it is literally like an ace bandage. A tiny price hike causes a massive drop in sales because consumers will just easily stretch away to find alternatives. Think about deciding to skip out on expensive restaurant meals.
But if it's an essential good like gasoline or life-saving medical care like insulin, the demand is inelastic. That's more like a heavy rubber tie-down. You can pull and pull on the price, but the consumer's demand barely stretches at all, simply because they have no other choice but to buy it.
Now, calculating this elasticity comes with a pretty unique math problem. It's this whole up versus down dilemma. Here's why. Taking a step up in price creates a totally different percentage change than a step down over the exact same numerical range. For instance, an increase from $4 to $5, that's a 25% jump, but a decrease from $5 down to $4 is only a 20% drop. This up versus down dilemma is exactly why economists have to use a midpoint average approach to calculate a standardized elasticity coefficient. Kind of a neat little workaround, right?
But because calculating midpoints can get a bit tedious, businesses often rely on a much simpler tool called the total revenue test. And this test is great because it clearly shows whether raising that price tag is actually going to increase your overall profits or if it's just going to drive away way too many customers. It's simple. You just watch the total revenue. If you raise prices and your total revenue actually goes up, your demand is inelastic. But if you raise prices and your total revenue falls, then your demand is elastic. And here is where it gets really interesting, because sometimes dropping your price is actually the most profitable move you can make. Take a look at what happens if demand is highly elastic. Lowering your price from $2 to $1 might feel like a loss at first glance, but it can actually result in your total revenue jumping dramatically, like going straight from $20 to $40. And that is simply because of the sheer volume of brand new customers flooding in just to take advantage of that cheaper price.
Okay, our final section, Section 5, Measuring the Market's Win, Surpluses.
Let's look at how we actually measure the win for both buyers and sellers in a transaction. First up, we have the consumer surplus. So your consumer surplus is essentially that invisible deal you just scored when you bought something for less than you were genuinely willing to spend on it. You know that victorious feeling when you walk up to a register fully expecting to pay full price, but the item miraculously rings up on clearance? Yeah, that's it right there.
For example, imagine you're just absolutely dying of thirst after a long run. You'd probably be totally willing to pay $5 for an ice-cold soda. But when you finally get to the vending machine, it only charges you $1. Your consumer surplus in that exact moment is a very tangible $4. You valued the drink at $5, you only paid $1, and you kept $4 of pure value right there in your pocket. Now conversely, sellers get to win too. Producer surplus is the difference between what a seller actually receives and the absolute lowest price they were willing to accept. Let's say you're an artist, and you're willing to let a beautiful sculpture go for $30 just to cover your materials. But then, an eager buyer walks in and enthusiastically offers you $100 for it. Well, you have just secured a massive producer surplus of $70. So, when you combine the consumer's win and the producer's win, you get what we call the total social surplus. And the ultimate goal of a highly efficient, perfectly competitive market is to absolutely maximize this total social surplus. When we sit right at that equilibrium price we talked about earlier, the total surplus is maxed out. Every single mutually beneficial trade has happened. This successfully avoids what economists like to call a deadweight loss, which honestly is just a fancy term for a missed opportunity where both a buyer and a seller could have won, but for some reason didn't.
As we start to wrap up this explainer, I just think it is incredible to realize how timeless these principles truly are. Over 700 years ago, the 14th century scholar Ibn Taymiyyah wrote that if desire for goods increases while its availability decreases, its price rises. On the other hand, if availability of the good increases and the desire for it decreases, the price comes down. I mean, human behavior when it comes to trading and valuing goods has remained just remarkably consistent across the centuries.
Next time you're standing in line, looking at a menu, or just browsing an online cart, I want you to remember the forces at play. Ask yourself, is this good elastic or inelastic? And when you finally click buy, ask yourself, who actually got the better surplus today, me or the store? Thanks so much for joining me for this explainer. Keep looking for those invisible forces hidden inside every single price tag you encounter.